We use money every single day, right? But have you ever stopped to really think about where it comes from? You probably picture, a giant printing press churning out cash, but honestly, that's just a tiny, tiny piece of a much bigger and way more surprising story. So in this explainer, we're going to pull back the curtain and see how money is actually created.
Just think about this for a second. Let's say you wanted to trade your phone for a week's worth of groceries. How would you even do that? You'd have to find a grocer who not only wants your specific phone, but also thinks it's a fair trade for all that food. I mean, the chances of that happening? Pretty much zero. It sounds kind of ridiculous, doesn't it? Well, that exact problem is why money exists in the first place. So way back before we had money, everything worked on a system called barter. And its biggest problem, its Achilles heel, is something economists call the double coincidence of wants. Now, that sounds super complicated, but it's actually simple. It's just a fancy way of saying, I have to have what you want, and you have to have what I want, both at the same time.
And look, this really breaks it down. With barter, it's just a huge headache. It's clunky, it's inefficient. You spend all this time just looking for someone to trade with. But then you bring money into the picture, suddenly it's the perfect middleman. Everything becomes smooth, simple, it just works.
Okay, so we've established money makes life way easier. But what does it actually do? What are its main jobs in the economy? Well, it turns out there are three really big ones. Let's get into them.
All right, first up, it's a medium of exchange. That's just the go-between we were talking about. Everyone accepts it. Second, it's a unit of account. Think of it like a universal yardstick. It lets us put a price on everything, from a cup of coffee to a car. And third, it's a store of value. This means you can stick it in your pocket or in a bank, and it'll still be worth something tomorrow or next year.
So money is obviously a massive deal. It's the lifeblood of our economy. Which brings us right to the heart of the mystery we're trying to solve today. Who or what is actually making all of it?
Now, if I were to ask you that question, what would you say? Probably the government, right? The central bank. You're picturing those giant printing presses, and you know what? You'd be kind of right, but only a little bit. That's actually a super small part of the real story.
Okay, so every country has a central bank. For India, it's the Reserve Bank of India, or the RBI. And yeah, they are the only ones who can print the physical cash, the notes and coins in your wallet. Economists have a cool name for this stuff: high-powered money. And trust me, it's called that for a reason. Because this physical cash, it's like the seed from which a giant forest of money grows. And this is where we get to the big secret. The shocking truth is that most of the money in our economy, it's not printed at all. It's created literally out of thin air by regular commercial banks every single day. Now, you're probably thinking, how is that even possible? Well, to get our heads around it, let's look at a simple story.
So, picture this. Once upon a time, in a small village, there was a goldsmith named Lala. Now, back then, everyone used gold to buy and sell things, but you can imagine carrying around chunks of gold is pretty inconvenient, not to mention risky. So villagers started leaving their gold with Lala for safekeeping.
And in return, Lala gave each person a little paper receipt, basically an IOU for their gold. But then something interesting happened. People figured out it was way easier to just trade the paper receipts with each other instead of constantly running back to Lala to get the physical gold. So these receipts, they became the new money in the village. Okay, now here comes the magic trick. A guy named Ramu comes to Lala and asks for a loan. He needs 25 kilos of gold. Lala thinks for a second and has this brilliant idea. He realizes, hey, not everyone is going to come ask for their gold back all at once. So he lends Ramu 25 kilos of gold from the vault. Now Ramu takes that gold and pays another villager, Ali. And what does Ali do? Get this, he takes the gold right back to Lala for safekeeping and gets another paper receipt. So let's pause. What just happened? The village started with 100 kilos of gold, right? And receipts for 100 kilos. But now, there are receipts for 125 kilos floating around, being used as money, even though there's still only 100 kilos of actual gold in the vault. Wild, right? And that is the key, right there. By making that loan, Lala literally created 25 kilograms worth of new money from nothing, out of thin air. And folks, this isn't just a fairy tale. This is exactly how our modern banking system works. Every single time a bank gives you a loan, it's not lending out someone else's savings. No, it creates a brand new deposit in your account. And that new deposit, that is new money.
Now, obviously, this power to create money can't just be a free-for-all, right? There have to be some limits. And there are. This brings us from Lala's simple story to the real-world mechanism that controls it all, something called the money multiplier. So, that main control is called the cash reserve ratio, or CRR for short. It's basically a rule from the central bank that says, hey banks, for every deposit you take in, you have to keep a certain percentage of it on reserve. You cannot lend this part out. It's basically the brake pedal for the money creation engine.
Let's walk through how this works. It's actually pretty cool. Say you go and deposit 100 rupees into your bank account. And just for this example, let's pretend this CRR, that reserve ratio, is set at 20%.
Okay, so right away, the bank has to take 20% of your 100 rupees, so 20 rupees, and put it aside. It can't touch it. But it can now lend out the other 80 rupees to someone who needs a loan.
Now, what happens next? The person who borrowed that 80 rupees goes and spends it, right? Maybe they buy something from a shop. The shopkeeper then takes that 80 rupees and deposits it into their bank account. And the cycle starts again. The bank keeps 20% of that 80, which is 16 rupees, and can now lend out the remaining 64.
And you can see where this is going, right? This whole process just keeps going. That 64 rupees gets loaned out, spent, and then deposited again, which creates another, slightly smaller loan. And on, and on, and on. And every single one of these steps is creating brand new money.
So here's the absolutely wild part. When you add up all the new money that was created from every single one of those steps, that first single 100 rupee deposit you made, it ended up creating a grand total of 500 rupees in the economy. This amazing chain reaction is what economists call the money multiplier effect, and there's even a dead simple formula for it. The multiplier is just 1 divided by that reserve ratio. So in our case, 1 divided by 0.20 equals 5. Your initial 100 rupees was multiplied 5 times over. It's incredible. So, let's wrap up with one last big thought to chew on. We've just learned that most of the money we use isn't printed, it's borrowed into existence. So that leads to a massive question. If the creation of new money totally depends on people and businesses taking out loans, what happens to our entire economy when everyone stops borrowing? Kind of makes you look at the whole system a little differently, doesn't it?